Hello there, welcome along to another video with Talk Financials, as usual with me, Johnny Wraith, and Ted Wainman, who's going to run us through the accounts today of Begbies Traynor. Formed in 1989, this is a corporate restructuring and insolvency specialist based in the UK, floated back in 2004, employing 700 people across 100 offices in the UK. As with every other company we've looked at recently, Begbies Traynors had a lot of impact to deal with for both good and ill over recent years. Back in the financial crisis period, obvious opportunities, but also threats and challenges for a company involved in corporate restructuring. More recently, it's had to navigate its own way through the pandemic and the recent price and geopolitical shocks. As I say, that's given them both threats and problems dealing with their own business, but also the opportunities that obviously come with a company of this nature. So Ted's going to run us through the accounts now, as usual, have a look, run the rule over the share price, give his views on whether or not it might offer value or how he sees the current valuation of the company, have a look at the CEO's pay, as usual, and then we'll have some other observations at the end around this company and its prospects. As always, these are just our opinions. It's not formal investment advice that we're offering, so please do bear that in mind. Do share your own views as well, like, subscribe, as always, to the channel. And on that note, I'll hand you over to Ted to take us through Begbies Traynors Outlook and accounts.
Thanks a lot, Johnny. Good to see you again, and welcome back to all of our viewers, or welcome if this is your first time you visited this channel. Don't forget to subscribe, and welcome back to our subscribers. And this is in fact a request from one of our subscribers. So John Matthews was asking about Begbies Traynor. He gave me quite a lot of information. Corporate and personal insolvency, you expect it to be popular, as Johnny said. However, forward PE of 40, that's the price to earnings ratio, so 40 times earnings looks pretty high, and he says it's a company which has relatively thin operating profit margins of 4.8%. They seem to be quite active, acquiring other companies. How do you evaluate such deals, etc. So with that in mind, let's go and have a look at their financial statements. Here they are. So these are the financial statements for 2022. And if we whiz all the way through to the income statement, then we will see that the the date of this is for the year ended the 30th of April 2022. So we're recording this in February 2023. So we're getting to the end of their next year. It's going to take them a few months before they publish those results. Okay, right, let's see what's going on. So here we are. We are looking at the revenue account. We're looking at 2022. And we are in thousands. So their revenue, their turnover is 110,000, so that's 110 million pounds. The direct costs are the costs of this restructuring and servant, which is basically going to be their people. Okay, so their direct costs predominantly there'll be other fees in there as well, but predominantly going to be people, and that leaves them with a gross profit of about 48 million. And 48 million works out at about 43% gross margin. So for every pound they bill their clients, it's costing them 57p to provide that service. They've then got their admin expenses, which is kind of the back office, which leaves them with an operating profit of about 5 million. So this is about 4%. So this is where John is identifying this kind of this very, very tight, low operating margin. It's actually up from the previous year, which is about 3%. So yeah, it's a pretty tight business. It's, there's not a huge amount, not a huge amount of profit in there. I have very little first-hand experience of these sorts of organizations, but I know that when a company does go bust, there's usually very little left over for either the creditors or the certainly the shareholders, as these guys will take all of their fees. Anyway, profit before tax, £4 million. And then tax, you'll notice that there's a kind of one-off charge here, which causes them to actually make a loss in the year. So they've made a loss of about £500,000. But if we ignore that kind of 1.8, then the profit is about £1.3 million. But anyway, these guys are making, a small loss due to this kind of this one-off deferred tax charge. Not sure exactly what that relates to. You can have a look at note 8, but it wasn't there last year, and we don't expect to see it again next year. So fundamentally, these guys are making a profit, although for this particular period, because of that tax charge, they are booking a loss. Profit, but not a massive amount of profit. Now, we'll come back to the movement in equity in a minute. Let's just have a quick look at the balance sheet. So first of all, we see in their non-current assets, biggest number by far, intangible assets. You remember, intangible assets, things you can't touch. These guys have grown through acquisition. I'm going to guess there's a lot of goodwill in there, and we can go and have a look at note 11, which will give us a little bit more of a breakdown as to what is actually in that number. So here we are on note 11, and what we see in note 11 is all of the intangibles, and you'll notice that yes, there is a lot of goodwill sitting there, but they've also got software. Now, obviously, that software has value to them, but probably doesn't have any value to anybody else. It's not something that they can sell on eBay, for example. And then they've got these intangible assets arising on acquisitions. And, there's some reasonable amounts here. There's the 75 million. Most of it is goodwill, but they have this intangible arising on acquisitions. And there's a little note down here that gives you a bit more information about it. And it's things like customer relationships, brands is in there, order books, websites, and I have to admit, I kind of just look at this and I think, I'm not sure they should I would just, brand should really be goodwill, surely. I'm not sure that you can actually classify the acquisition of brands onto your balance sheet. So obviously they are allowed to, and they can, but you can't put your customer relationships on eBay, for example. So really, when we're talking about these intangibles, it's that there's no real kind of inherent value there. There's nothing you can sell on should you need to. So we can kind of classify, pretty much all of that as goodwill, as I'm concerned. It's effectively goodwill by another name. So it's all goodwill. They've got some trade and other receivables, some cash in the bank, 10 million of cash in the bank, so it's pretty good. Trade and other payables, that's what they owe to their suppliers. Quick look at the liquidity ratio, not an issue, comparing the current assets to the current liabilities. Little bit of debt, some lease liabilities. Those lease liabilities will be based sitting behind the right of use assets. That's this number here, and this is going to be tables and chairs and et cetera, et cetera. And they don't have a lot of that because they don't need a lot. It's going to be a few consultants' laptops, effectively. And so they've got this pretty healthy balance sheet, but the balance sheet is basically all driven through that goodwill. And I would suggest to you that there's kind of, if you want to look at the balance sheet in its pure form, you need to remove that goodwill, and therefore, there's not a lot of assets there. But then, of course, if you buy this company, you're not buying the assets; you're buying their ability to earn, to generate a profit. And there is their retained earnings. Now, you notice the retained earnings has come down a little bit. Now, this is where we go back to the movement in equity. So when we're looking at the equity side, this retained earnings, each of these kind of the differences between last year and this year is all shown through the movement in equity. We're particularly interested in what's going on with this retained earnings. And there's a couple of little funnies going on here. So here's the retained earnings. We're interested in this column here, and you'll notice there's the profit. We're looking at last year. There's the profit from last year. There's the loss from this year. They are paying out dividends, 3.5 million last year, 4.5 million for this year. And by this year, I mean 2022, the year that we're actually looking at. So these guys are paying out pretty consistent dividends, which is quite interesting because they haven't got the profits to pay out the dividends. Well, what they have got is this amount here, which is a transfer from the share premium account. So the share premium, now the share premium arises when you sell some shares and you sell it at more than the kind of the nominal value. The nominal value gets stuck into the share capital and the rest gets stuck into the share premium. Effectively, we can take those two together and just say that's what they physically raised from the investors. So they've raised 20, so they've reclassified 20 million of capital that they raised in the past. And then what we notice here is that they've actually raised about 20 million. So this is slightly bizarre. They've raised 20 million, then they've reclassified it as retained earnings, which allows them to pay out dividends. Now, I'm not sure exactly why a company would want to do that. I have a theory, and I'll come back to that theory in a minute. But it just looks a little bit bizarre that this is a company which is effectively raising money from its shareholders and then returning that money to its shareholders in the form of a dividend. Slightly bizarre there. Anyway, so that's kind of what's going on in the balance sheet, in the movement into equity. Last bit is the cash. They are generating cash. There we go. There's a kind of 10 million or 9.8 million, 13 million the previous year. A little bit of investment going on. You'll notice the previous year, this acquisition of a business. So they spent 22 million pounds buying businesses. So they are growing through acquisition, and that's driving a lot of that goodwill. And there are the dividends that they are paying out. And you'll notice in the financing activities, there is the raising of the money. So effectively last year, they've raised this cash. They then, I think what they did is that they raised the cash and then they kind of used it to buy the money and then reclassified it as a retained profit. Again, it's all a little bit kind of a little bit strange, I have to admit. And they've been paying down a little bit of debt. So summary is that they make 10 million in the year. They don't actually really do any investing, nearly 1 million of investment, 7 million in financing, and that leaves them with an extra 1.7 million, and which is why their cash balance has gone from 7.9, nearly 8 million, up to nearly 10 million this year. So there's the kind of there's the core numbers. Now I thought we'd just have a quick look. I mean, usually we do this after the share price, but we'll have a look at the share price in a minute. But before we do that, while we're here, let's just go and have a look at the remuneration. So the remuneration is quite interesting. For the CEOs, the CEO, the remuneration is on page 34 of this document. And we kind of like to just keep it nice and simple, go for a single number. So there is Rick Traynor, and he is earning 678 million, sorry, 678 million pounds, sorry, £1,000, because it's in pounds here. Okay, so 678,000 pounds. And Nick Traynor, Nick Taylor, who is the finance director, is on about 400,000. It's a bit of a rise on the previous year. There you can just see the previous year down the bottom, so 588, so about a 15% pay rise. And if we compare that to the employees, we can find the employees are on page 59 of this document. So here we see the employees, staff costs. So total staff costs, and we'll just move this up so we can see the actual staff numbers. So 690, nearly 1,000 staff, basically 987 staff, and they're being paid 67 million pounds, which works out at about 68, just shy of 70,000 pounds per person. And the previous year it was about 66,000. So staff on average 68,000 576, so about 69,000. They've seen a 3% increase in their pay. Rick has taken a 15% increase in his pay, but then Rick is only being paid 10 times the average salary. So, you know, Johnny, we've seen some sort of crazy multiples from some other businesses. So that is not a kind of a mad multiple on this one. However, I did sort of scratch my head when we were looking at the remuneration of the CEO, because what's also shown here is the director's interests, and you'll notice that Rick has a substantial interest in the business. So he has a substantial interest in the business, and therefore, well, that's 18% last year, so 70% this year. So what we can see here is that he owns less of the business. Now, I'm guessing here, okay, and this is pure speculation, that he owns less of the business because when the company has issued more shares, he hasn't bought those shares. But of course, if he owns 17% and the company pays out a very substantial dividend of £3.5 million, he will take 17% of that £3.5 million. Okay, so a company has a whole lot of shares in issue. When they want to raise more money, they will usually do a rights issue, and they will use that rights issue in order to, effectively allow existing shareholders to maintain their current existing ownership. It looks to me like in the last issue from 2021 that Rick has not been maintaining. It doesn't look like he's been buying those shares, and then it just seems slightly bizarre to be reclassifying, raising all that money, reclassifying, and then paying it out as a dividend. And I can't help feel that it's somehow linked to a substantial shareholding by Rick Traynor. And you know what, he's only earning 670. I mean, I say only 678,000. It's a fairly substantial amount, but it's not in the kind of the crazy brackets that we've seen some of the CEOs, and it's clearly his company, and therefore why shouldn't he be well remunerated for it? It's just I personally would feel a little bit nervous if I was an investor in this, investing in a business in order for it to pay dividends. That kind of, that sounds a bit crazy to me. I'd rather you invested it to do something else. Now, I may got this completely wrong. And if I have got it wrong, then I'm sure that somebody will correct me. So please do use the comments and correct me if I have got it wrong. Obviously, do remember to be polite. So there you go. There's our analysis of Begbies Traynor. So what does that mean for the share price? Well, as we'd expect, during the kind of, here's the global financial crisis of 2007, 8, and this company, suddenly everybody thinks, wow, these guys are gonna, they're gonna make a lot of money. As everything sort of starts to fall apart, and then actually interest rates have dropped. We enter that zero interest rate policies, the ZIRP, etc., and these guys they see a big decline as the economy comes back, and then they just been making a slow recovery as people are starting to think actually maybe these guys are they're set to make some more money. And this was John Matthews's point. However, it's a high P ratio. It's expensive. They are expensive, compared with their earnings. Now they've obviously got a P ratio. We calculated a loss on our business, but even if you kind of ignore that, you remember that kind of that one-off tax charge, if you've got 1.3 million and you're paying 223 million, you're paying many multiples of the earnings. I mean, I've actually got my calculation says 170 times earnings. These guys say 66 times earnings. Whichever way you look at it, it's expensive. They got a dividend yield, but I don't think that dividend is sustainable. You can't carry on paying out dividends of 3.5 million if you are only making profits of, say 1.3, core net profit, for example. So the dividend yield is low. The dividend isn't sustainable. I think that a lot of people have decided that these guys are set for the there's going to be companies going bust with high interest rates and maybe a recession, etc. Personally, if you buy into that, I think there's a lot of people who've already bought into it as well, and that therefore it's already reflected in the price. So there you go, Johnny. That is my kind of analysis of Begbies Traynor. Some funny stuff going on in the accounts, raising money, buying companies, and then turning that money into, what's being raised into a profit, and then returning it back to the shareholders in the form of a dividend. The dividend doesn't look sustainable to me. And if you're buying for their future opportunity, I kind of feel you might have missed the boat.
Yeah, it's very interesting stuff going on there, Ted. And as you say, slightly unconventional aspects to the accounts anyway, which give everyone food for thought. I mean, there's obviously an interest in this company partly because of this view that bad news is good news for a company that specializes in insolvency and restructuring. I was just looking when you were talking a story from a couple of weeks ago on the BBC website, Begbies Traynor reporting that there had been a 36% jump in companies in financial distress in the last quarter, the last 3 months of 2022. Clearly that creates potential opportunities for them, and the worse things get for everybody else, to a degree anyway, the better they get for a company like this. So you can see perhaps why, despite some of this sort of funny business arguably going on in the accounts, there are people who still think this is a company that represents value. And maybe if you're on the pessimistic side of things, we're all expecting a recession and trouble ahead. But, if you think things are going to be even worse than is priced in at the moment, arguably, you might want to get out of some of the sort of going concerns if you're worrying that they're going to get into trouble, and move into some of these companies that might pick up the pieces if and when things do get worse. So, it's an interesting debate. And I suppose I would view, based on what you've just said, this as a share that's sort of fully priced for what we're all anticipating, and potentially then some. So if you think things are going to play out roughly in line with expectations, there probably isn't a lot of value. But if you're seriously pessimistic, well, maybe there's a sort of, throw the dice and jump on board in the hope that they'll, be a relative winner in some pretty ugly macroeconomic times ahead. That's the way I see it. What do you think of that?
Yeah, I think you're right. And don't forget, it's like if you buy something that's really expensive, you've got limited upside, but a lot of downside. If you're a true value investor, you're buying the stuff that nobody else likes, and everybody likes this. So you're not a contrarian. You're going with the crowd. And I just think it's kind of, there's not a lot of room for upside, and there's potentially a lot of room for downside. And that's just kind of my feel. It's that fact that dividend isn't sustainable. It's that little move. It just makes me, I don't feel comfortable with it. Why would a company be doing that? That's a really bizarre thing to do. Now, there may be a perfectly valid explanation. I don't know what it is. And if I again appeal to the viewers, if anybody does know why they're booking those profits, while they're transferring that investment into the profit, then please let me know, because I have no idea. And don't forget, it's all, the balance sheet. I mean, if you buy a company with a balance sheet of let me just work it out. So if you buy a company with a balance sheet of 85 million, I think their balance sheet was, and you're paying 223 million, you are paying 140 million more than it's worth. And don't forget that balance sheet is all goodwill. It's all intangible. There's really nothing else in there. You're not buying, so this entire company is goodwill. You're buying its ability to generate earnings. There's no asset sitting behind it, basically. I mean, as far as I can make out, the balance sheet's probably, fair value of the balance sheet is probably about 10 million.
Wow. Yeah. Well, there we go. That's a very interesting company to have had a look at. As Ted says, if anyone's got a view, or indeed an explanation which differs from the one Ted put across as to why this company might have raised money only to sort of repay some of it straight back to the investors again, do please share those comments, and any others in the comments. Like it if you've liked it, subscribe if you haven't already, and you'd like to see more of this sort of stuff. And I think that wraps it up for Begbies Traynor. So thank you, Ted.
No worries, Johnny. Good to see you. Catch you later.
See you next time.
Hello, thank you for watching that video, and I hope you found its contents useful. If you want to know more about what we do here at Talk Financials, you can find out on talkfinancials.com, where we will explain how we design, develop, and deliver training workshops for companies all over the world. We've worked with over 300 companies in over 35 countries around the world, helping them to understand financial statements, to understand business finance, and to become fluent in the language of business finance. If you're interested in developing your own skills in how you read and interpret financial statements, I've developed an online workshop which is available. All you've got to do is click on the QR code there, point your camera at the QR code, and that will take you through to an online workshop, and it will help you to improve your own ability to read and interpret financial statements. I've also written a book called How to Talk Finance, and again, that is available. If you click on the QR code, it'll take you through to the Amazon website where you can buy the book either as a hard copy or as a Kindle edition. And that's really everything from me. I'm on LinkedIn. It'd be great to stay in touch. If you'd like to contact me, then again, just click on the QR code and send me a message. And good luck with your financial analysis. I hope it goes well.